Welcome, everyone. Before we get started, again, one more administrative item for any of you who participated in any investment-oriented webinars or seminars in the past. Of course, I have to give you this disclaimer. Anything that we're about to discuss today should not be considered any kind of investment, financial, or tax advice. We certainly hope that you'll learn something new, and that's the purpose of this webinar, is for educational and informational purposes. Now, if you decide to implement any of the strategies that we discussed today, we strongly recommend that you do your own due diligence or you contact a qualified financial, investment, or tax professional before you decide to do so. With that, let's get started. And for those of you who haven't met me yet, my name is Alex Seleznev. I'm the founder and president of Capital Squared Financial. I'm a chartered financial analyst and certified financial planner. I've been in this business for over 15 years now. And in terms of Capital Squared, well, our specialty is really on transitions. So post-divorce, as an example, when someone receives an inheritance, usually that results in a transition of sorts. And of course, your eventual transition into retirement. For most people, it will likely be the most important transition that they'll ever make. And one thing I'll say, you certainly don't want to retire for the second time again. That is our specialty, to make sure that you do it successfully and that you stay in retirement without running out of money. We offer truly individualized investment strategies to our clients. We always start from scratch. We don't have any cookie cutter models. So each and every investment policy matches each of our clients' financial or retirement plans. Now, what also makes us unique, we're very proactive when it comes to tax planning. We discuss different options with our clients in our semi-annual meetings. We, of course, encourage them to reach out to us and ask related questions. That's, of course, a very big part of the process. We're a fee-only firm. We always serve as a fiduciary. When we work with our clients, we're fully independent, and essentially what that means, any type of advice that we provide to you, it has to be in your best interest. Last but not least, we're also very responsive. We almost always address our clients' requests within 24 hours, or at least we acknowledge that we receive your requests, and everyone very much appreciates that. If you want to learn more, please visit our website, or of course, feel free to contact me directly. Now, my co-presenter today, Asi, I've known Asi for more than 6 years at this point. We met through the local CFA chapter, CFA Washington, D.C. Now, Asi is quite exceptional, to say the least. He is the managing partner and chief investment officer of Rock Den Advisors. He's in Alexandria, and he opened his wealth management firm in 2021. Prior to that, Asi spent 25 years at Wall Street banks and investment firms. Most recently, he was with UBS on the institutional equities desk in Singapore. He spent a decade as an equity analyst and portfolio manager at hedge fund Diamondback Capital and investment managers Axiom Investors and Emerging Markets Management. Asi also began his career at one of the top French banks, which unfortunately I cannot pronounce, so I apologize for that. Now, one thing I'll tell you, Asi knows a thing or two about investments, and I actually personally look forward to what he has to share with us today. So for those of you who participated in our quarterly market updates in the past, I try to start with some humor. Not everyone finds that funny, but in terms of the cartoon that you're seeing here, well, that hopefully associates with you in terms of where we are in terms of the markets. Well, over the past 6 to 8 months, they just seem to be going up, and up, and the only question is exactly when will that end? And well, as many of us know, the bull markets eventually end, and very frequently that does not end well. So one of the messages, and I'll repeat it throughout the webinar today, and this is a great time to prepare for that. In terms of the format, again, it's going to be similar to how we covered this in the past. I'll update everyone on where we are in the markets today. Then Asi will share some of our, some of the top ideas in terms of the themes, such as the election year ideas and the Magnificent Seven or Magnificent Four at this point stocks. And then closer to the end of the webinar, we will share some of our top considerations, hopefully practical for you, so you can walk away with something to consider. So in terms of the market conditions, the data on this slide is as of last Friday, but things haven't changed all that much over the past couple of days, maybe down by a little bit. The US market, as measured by the S&P 500 index, is up by a little over 5% at this point. And of course, in 2023, and I hope many of you know at this point, it was a great year. The markets were up by 26%. Now, that's certainly not bad, but if you look at the performance of the NASDAQ index, which is really dominated by technology and consumer discretionary stocks, well, the index was up by 37%. And of course, many or several stocks, I should say, in that index, they were up by much more than that. Domestic small cap stocks, they actually had a mini rally at the end of last year. Perhaps the expectation that interest rates will be lowered this year. They're essentially flat for the year, and we'll talk about this more. Perhaps one of the reasons behind that is because interest rates are expected to stay where they are for longer than originally expected. Developed and emerging markets are up for the year, not by much. Not that it's representative of much, because we're still only getting closer to the end of February. They had a pretty decent year last year. Developed international were up by 18, and emerging markets were up by 9%. Now, domestic bonds, as measured by the Barclays Aggregate Bond Index, are in the negative for the year, which again is not necessarily surprising, because the expectation is that interest rates will remain higher for longer. Last year, though, the entire bond category performed reasonably well at 6%. In terms of the 10-year Treasury yields, we certainly keep track of those. Think of them as the market's interest rate. So there is the Fed rate that the Federal Reserve Bank can decide what it's going to be, and then there is the 10-year Treasury yield that they cannot necessarily control, or at least they cannot control directly. So what's interesting here, throughout most of 2023, it remained mostly at the same level. There were some fluctuations, but not particularly significant. Notice that as of last Friday, the 10-year yields are at 4.3%. So they actually went up when compared to where we were at the end of the year. In terms of the sector performance, in some sense, no surprises to anyone who's been following the markets for some time. Communication services and information technology, mostly growth-oriented sectors, are up for the year. Both sectors had a pretty good year last year. Utilities, which considered to be some of the most conservative stocks out there, are in the negative, which kind of tells you that the markets are still bullish about the future. And then real estate, which is usually not considered to be the most conservative necessarily, also in the negative, again, mostly because interest rates are expected to stay higher for longer, and the real estate market gets impacted by that perhaps the most. Now, in terms of the performance of different styles, and for any of you who manage your own investments, this is actually important. And for us, of course, when we rebalance our clients' portfolios, essentially what this shows you is the performance by style. For those of you who are less familiar, there are three styles out there. So you have growth, and these are companies that are expected to grow their market share, their revenues in the future. They tend to not necessarily pay that much in dividends. And of course, technology stocks would be a perfect example of a company like that. On the value side, you have more dividend-oriented, more mature companies. They usually generate a lot of stable cash flow, but at the same time, they're not necessarily expected to grow that much in the future. And then in the middle, you have this so-called core companies that in some sense, they have features of both growth and value stocks. Healthcare, by the way, is a good example of a core style, and then the value, utilities and energy would be good examples. So again, last year, the markets were essentially dominated by growth stocks. Notice that large cap growth stocks were up by 47 percentage points, which is quite something. In terms of the year-to-date results, and understand again, we're only talking about 1 month here, so it's not necessarily representative of much. But again, large cap growth stocks as a category, and Asi will talk about this more, they've been performing reasonably well. The rest of the market is relatively flat though. Now, this is the same slide that I actually used in our previous quarterly market update, and I decided to keep it here. And the reason I wanted to show you this is because, when Asi talked about this, he mentioned this recency bias. It's actually very important. So many people have this assumption that something that's been going up recently will continue to go up in the future, and that's understandable. Sometimes I catch myself thinking that way as well. Now, when you look at the performance of different styles in the long run, this is over the past 5 years, notice that growth stocks actually slightly underperformed core holdings, not by much, but slightly. They're certainly doing better than value-oriented or more conservative stocks, which makes sense for different economic reasons. But still, the difference isn't 20 or 30%. So I just want to point that out to you. Again, this is one of the reasons why consistent rebalancing makes sense, because in the long run, it's really hard to tell which style or which asset class will perform better. So the next one is the asset class returns quilt. Again, for those of you who know me, this is one of my most favorite charts to review. I pay close attention to it on a monthly basis, and we'll also talk about it in our quarterly market updates. Again, if you're less familiar, essentially it shows you the performance by major asset class year by year. So from 2014 all the way to 2023, and on the right side you've got the average return or the annualized return per asset class. And there's really a lot that we can learn from here. So in terms of 2023, again, no surprises. We already talked about this. Domestic large cap stocks, they're the best performing asset class. International stocks perform reasonably well. Notice that commodities were down as a category by almost 10 percentage points. And when I say commodities, I'm referring to a basket of different commodities. So it's gold, silver, oil, platinum. I believe there's 10 different commodities that are part of the index. Now, if you study this graph, you'll notice that commodities are essentially in the negative or in the bottom for most of the years, with the exclusion of more volatile years for when inflation is above average, just like it was in 2022. Now, and that's again one of the things in terms of our approach at Capital Squared. We're not all that optimistic on commodities in general. We do occasionally use it as a hedge against inflation, but it's not likely to be the best, buy and hold type of asset class. I just wanted to point that out. Now, the other piece I wanted to perhaps focus more, a bit more today, there's that whole theory, and I remember spending a lot of time studying it, when I was studying for the CFA exam and just in general, in terms of, global diversification, the idea that you should keep, your assets in different pockets, in different baskets. And there's certainly something to be said about that. Like most of the world's population, as an example, lives obviously outside of the US. But when you look at the performance of international markets, and specifically emerging markets, where it says EM here, well, notice that over the past 10 years here, so that's in the entire decade essentially, it certainly has not been all that impressive, and certainly has not been all that consistent. So that is, again, and I perfectly understand that the past performance results are not necessarily indicative of the future, but there's still that, there's the promise of above average growth when you invest outside of the US, but in practice, again, it has not been the case, at least not over the past decade or so. Domestic bonds, again, in terms of our firm's specialty. We specialize, again, working with clients who are, thinking about or transitioning or in retirement. So bonds are very important for us. We're really big into building so-called bond ladders. And, for those of you who know me, I talk about that a lot. Now is the time to consider this option. There's so many choices available to you. And what you're looking at here, this is the inventory essentially that was available to us last Friday. And it's very similar through our platform, Schwab Institutional. So what this graph shows you is the yields for different types of bonds. Not necessarily planning on discussing the whole thing here, but one option, again, if you're thinking about rebalancing your portfolio, is to build a short bond ladder that consists of domestic treasuries. So, most consider them to be essentially risk-free, up to 1 year. So 3, 6, 9, and maybe 12 months. And you're going to get pretty good yields, anywhere between 5 to 5.4% almost. There's also the tax benefit because, treasuries are not taxed at the state level. Specifically for those who are, higher mid to maybe higher tax brackets, municipal bonds can be beneficial. So notice that their tax equivalent yields are, above 5.5% for certain categories, but it can be much more challenging to find them. So usually, again, I'm not trying to, but usually you would not want to do that yourself. Usually you would want someone who's doing this professionally to assist you with that. The bottom line is, again, compared to where we were, 2 years ago, specifically 5 years ago, like pre-pandemic, I remember it was so challenging to build any bond ladders because there were no yields. But at this point, there are just so many options that are available to us. Now, this is one of the slides I thought I would just add at the end. Perhaps this is obvious to many of the participants, but I thought I would bring that up. So one of the advantages of buying individual bonds, and I'm certainly not saying that your entire portfolio should be in individual bonds. There are benefits of having mutual funds for more complex strategies like total return, high yield, global strategies. But when you buy individual bonds, specifically treasuries, there's actually no transaction fee. So you can buy them for free and you can always do that. There's usually a nominal fee involved when you buy municipal bonds or corporates, but it's really not all that significant. So when you deal with the larger portfolio in bonds, I used $500,000 in this example, well, this can result in significant savings. $2,500 a year is an example, multiplied by a certain number of years. Well, that can be, again, significant. So keep that in mind. That's, again, one of the benefits of investing in individual bonds. In terms of the economic conditions, again, usually we don't necessarily spend that much time here. I'll just say that overall, if you focus on the numbers without necessarily going and looking at different sectors, well, the economy is doing reasonably well. Again, the unemployment rates are low at 3.7%, and the expectations, going forward over the next few years is that, again, the unemployment numbers will remain at more or less the same level. In terms of the latest employment report, 353,000 new jobs, were added, and that was actually twice what economists had forecast. So there's something to be said about that. And of course, for most of you reading newspapers, there are all of this updates about the tech layoffs, and sometimes there are, not that many people perhaps notice them in the big scheme of things. But overall, again, the economy seems to be doing quite well. Now, in terms of the estimates, well, not so much estimates, but the actual results, in 2023, the US economy grew by 2.5%, which was actually pretty consistent with the expectations. There are different, estimates for 2024. Of course, we decided to use the IMF, or International Monetary Fund, estimate 2.1%, so a slight slowdown in 2024. No recession is expected. Again, in terms of what I've been reading, and I'm sure you can find, an analyst there, and I have my own thoughts that I'll share with you in just a moment. But in terms of the big picture, we're not expecting a recession. In terms of inflation, again, it's been gradually declining at 3.1%. as of January. Of course, the Fed would prefer to be closer to 2%. Who knows exactly how long it's going to take for it to get to that point? But again, it's at a reasonable level as of today. So in terms of the market outlook, and again, Asi will share a few other thoughts, but in terms of the big picture here, well, we do believe, just like it was in 2023, that the markets will continue to be driven by interest rate expectations. And that's very important. That's why I put it in italics. It's not so much what actually happens, but what people expect to happen. One thing I would say it's pretty clear at this point, unless, of course, something unexpected happens, is that this so-called hard landing scenario for the economy has been avoided. And again, for those of you who remember, so in the middle of 2022, at the time, it was all about essentially two scenarios. Are we going to have a soft landing scenario when things are, not as bad, when they're bad, but not as bad? Or will we have a hard landing scenario when essentially the economy crashes? Well, that's certainly not expected to happen, at least based on where we are today. Now, earlier this year, the markets were anticipating 6 rate cuts throughout the year. The assumption was that the first one would actually happen in March. As of today, the markets are now anticipating 5 rate cuts, and the first one is expected to happen in May. And this is where, someone like myself, and Shiraz has been reading a lot about this. When you look at the numbers, when you look at the economy and you kind of pause and think about all of this, and you say, well, what happens if interest rates remain higher for longer? I mean, it's great to have that, wishful thinking that, the Fed will just start lowering them. But again, if you look at the economy, if you look at the unemployment rates, everything seems to be doing reasonably well. So then the next question that kind of comes to mind, well, what happens if the Fed does not cut interest rates in 2024? What happens with all of those expectations, specifically for certain, growth-oriented stocks that are more, interest rate sensitive? And, the more I start thinking about that, and several other people, I share this thoughts, sometimes they, happen to agree with me. But the bottom line, again, this is a good time to be prepared. At this point, there's really no excuse not to be prepared, because again, we're starting the year after exceptional performance in 2023, essentially across most asset classes. So again, the message here is really to be prepared. Asi?
Thanks, Alex. Hi, everyone. I am delighted to speak to you all. I'm going to take a stab at touching on a couple of themes that have been pertinent for the last year, and perhaps going to be this year as well. Let me see, Alex. I'm going to see if I can control. Okay, I do control this little cursor. So the first theme is the Magnificent Seven. If anyone reads the financial press, you should be pretty comfortable with this idea. You understand it. It's the idea that these 7 companies, the top bullet point shows you which 7 companies make up the Magnificent Seven, have dominated the performance over the last year, a little bit longer than that. The chart on the right, I apologize, it's not the clearest chart, but I'm going to explain. It's easy enough to follow. The yellow orangish line is the performance of the Magnificent Seven. The blue line is the S&P 500, and the gray line is the S&P, I call it the S&P 493. So the S&P minus these 7 large stocks. And this chart period captures February 1st, 2023 to February 1st, 2024. And what it shows is that essentially all of the performance last year in this large index, S&P 500, which is 500 companies, came from these 7 companies, the Magnificent Seven. And the other 493 essentially gave you no returns over this 12-month period, which ended 1st of February this year. I guess the less favorable interpretation is that the 493 companies give you a better signal about the underlying economy, that i.e. they're not the economy is not doing so well. Therefore, that's why these 493 companies haven't gone up. But the flip side is bullet number 2 on the left side. The earnings of the Magnificent Seven have far outstripped earnings growth at the 493 companies. So that, you can argue, at least in the interim, relatively short term, 1 year, 1 to 2 years, there is much stronger growth, and that's why these companies have gone up. What the end result is that the concentration of the S&P 500 is at a historic high. So in 2023, we started the year with these 7 companies accounting for 20% of the S&P 500 index weight. We ended the year at 30%. So the typical diversification benefits you get from owning a broad diversified index is less today than at most points in the history. And this is not necessarily a longer term positive. What's happened to this performance from the Magnificent Seven in 2024? As Alex kind of alluded to at the very beginning, it's actually gone from I would call from Magnificent Seven to Magnificent Four, because Tesla and Apple have come down this year, whereas the other 4 stocks have continued to power ahead. And the 2 taller bars show you, this is a chart to the 5th of February. To the 5th of February of 2023, the 7 stocks accounted for 53% of the performance of the index. This year, the 7 account for almost 60%. And in fact, if you removed Tesla, which is down this blue down bar, and you remove Apple, then there's just the 4 or 5, I would say, would account for an even larger percentage. So this is additional, the term you hear is narrowing of performance. The entire index is going up on, 5 stocks essentially. And again, not something you want to rely on over longer periods of time, and certainly not something that's worked out over longer periods of time. And that's